Okay, we are recording.
All right. Well, I want to thank everybody for coming. And if you're getting here late, you're looking at this recording, thank you for watching it. Jonas has a wealth of information for us today. I know his name tag says Jesse. We were teasing him. His brother is Jesse, and they're twins, and they both run our renovation department. I wanted to say that before I came to Guaranteed Rate 5-6 years ago now, I did these loans by myself, and they're difficult and detailed, and things are changing. At Guaranteed Rate, we have a wonderful department that does the whole thing. Jesse and his brother Jonas run it, or Jonas and his brother Jesse run it. I'm looking at that name. And so if you have a customer for me, they will stay my customer. I stay in touch. I become what we call a project manager on the file, but the renovation team really takes over, and they really know what they're doing, and it becomes a much better experience for your borrower, setting expectations, etc. So thank you so much for your information today, and you guys ask questions, and I turn it over to you, Jonas.
Thank you for the introduction. Yeah. So I'm going to run through these slides again. I packed a bunch of information in here. If you do have questions, I have my chat up on the side, and so I'll try to be able to respond to those. But if I can't, I'll get to them all at the very end. There's a little bit of time for Q&A. Okay. So can everyone see expand inventory with renovation financing? Is that what you guys are seeing right now? Just to make sure.
Yes.
Okay,
Yes.
awesome. Okay. So Jesse and I did a presentation about a week and a half ago, and it was geared towards this. And so I thought it was very timely and useful for where we are in the market right now. And so I think renovation could be a big solution for some of the needs that our home buyers and home sellers have as well. So let's jump into it. So how do you expand inventory using renovation financing? Oops, sorry. Expand your existing housing market. So the data that I'm going to pull up for you is snippets from a national HUD consultant that we partner with. These are his examples that he had for clients that he's worked with. So these aren't necessarily mine, but it illustrates what we're talking about here. So on the first slide, you can see you might have a client that's in the market to buy a home, and all they're thinking about and all you're thinking about is just going out and buying them a house based on what they're pre-approved in. So let's say in this example, the price points is $550,000. You know, when it appraises out, it's $550,000. They might be frustrated because in the market at the price point, what they're looking for, there's only 2 properties. Well, with renovation financing, it opens the door to more properties. And so some of the examples that we have here, you can see 3 through 7 here, we got a $455,000 purchase, where if we put $75,000 in upgrades or renovation to it, then it's now a $580,000 property, building in $50,000 worth of equity right out of the gate. Okay. I'm not going to run through them all, but you can see again, different price points, different upgrades, values, all increasing and giving an equity position. And I tell people up front, you know, we want to be certain that when we're doing home improvements that we're fixing the right things. People ask me what's the right things to fix. Fixing the right things are going to be, when you look at an appraisal, it's typically bedroom, bathroom, square footage count, upgrades to the master bedroom, bathroom, kitchen, right? Those things all appreciate well. Here's another one. Again, same type of illustration. This price point's a little bit higher at $825. And you buy at $825 without renovation, it's worth $825. Here's some extremes. You can see we got a $295 purchase, put $405,000 into it, worth $750,000 in appreciation right out of the gate. And then everyone likes before and after pictures. So I want to show you a handful of those. You can obviously see on the left the older outdated home with the renovation. We started here, purchase price $400,000. Did $375 in upgrades. appraised at 825, building immediate equity at 50,000. Here's another one. 575 purchase price, 175 in upgrades. I got more than 2 pictures here, so you can see the back of the house. Appraised at 825, giving 50,000 in equity there. Now this one, the HUD consultant, his name was Peter. This was in New Jersey. So he said purchase price was 350, did 275 in upgrades, appraised for 665, 40,000 in equity there. You can just see, just put another floor, a level on top of that house. Some interiors. We had a REO purchase at 350 with 65,000 in upgrades, appraised at 450, 35 in equity. And I'll just run through these again. I always enjoy the befores and afters, and I think it allows your creative juices to flow. You know, it's where your clients might not always have a vision. They know what they look for, but they can't find it. And, you know, I've told realtor partners in the past, most clients come to you and they have an idea of what they want. And if you've checked off the boxes, you found the right school, the distance from work to family, but yet they just don't like the house, you've done your job. There's an opportunity through a renovation loan where we can get it to the way that they want. And so we don't need to put them in the car one more time. We can just provide solutions to them with the right loan. And they got 375, 590 in work here, appraised for over $1 million, 85,000 in equity. So let's talk about benefits here. So for our buyers, obviously increasing the inventory, that's what all these slides have been up to this point. Offers a lower starting price. So typically what you'll see, for those of you that have been involved in a renovation loan before, if there's issues with the homes, typically the sellers are coming out the gate willing to work with you on the purchase price or listing for less. Okay, so it's something to where we also provide the financing options on flawed properties in a flawless neighborhood. So if the client is wanting to get into a nicer neighborhood, but the price point's too high, if there is a property that's got a little bit of work that needs done to it, they might be able to get into that. Okay. And then overcoming the appraisal challenges. Again, if you guys have been doing this long enough, I'm sure everyone has had it where the appraisal called out work that needed to be done prior to closing on the loan, which then seller has to fix it, or we have to do a renovation loan or somehow get that addressed. Now on the seller side, shortens the time on the market. So again, I'm sure if you've been doing the business long enough, you have properties that just sit and sit and sit, you mark it down. If we are marketing it in a way that we deem it as a renovation ready property, we can get a contractor bid addressing what everyone sees as the issue. We can put numbers together on what a renovation loan would look around it, and then we could show the vision to the client on what a renovation loan could do to be able to move that property in a shorter period of time. Already talked about this, but again, it negates the needs that would be called out for repairs on the appraisal. And then we can get a higher offer price for the sell side if we aren't having to compete with cash. You know, those people, cash is king. They want to buy the property for less. Your client on the buy side, if they're approved with a renovation loan, they could come in with a higher ask price. And then increasing the neighborhood appeal with the renovation. So what I'm talking about here is, you know, people in your neighborhood are going to have concerns and fears that property that hasn't been maintained well is going to sell for less, and it's going to bring the value down for everyone involved. If we come in with a renovation loan, we're going to close on it and we're going to start the work. They're going to see the improvements to the house, just like the one behind me here. And it's going to continue to hold the value for the neighborhood because we're taking care of the issues. and then the millennials. So what I want to point out here, if you look in the bottom right here, it says millennials now make up 43% of home buyers per the National Association of Realtors as of March of this year. So for those of you that are dealing or have dealt with millennials and renovation, they don't want to do the work. They want the property the way that they would like it. They want to make it their own. And they can be more challenging to find the right property too. So the renovation is a great product for them because it allows them to make their home their own. And they don't do the work. We get the contractor out there to do the work for them. Okay. So let's talk about what this renovation is that I've been speaking about. Okay, I'm just going to put all the bullet points up again so you guys can look at it, but also so I can move quicker through the slides. So you may or may not know, but with the renovation loan, everything that we're doing is based on the after improved value of the home. We lend on that. We don't lend on the purchase price. The realtor's commission is paid at closing. I share that just so you understand. Again, if you've been involved in this, you already know. But as far as attorneys, titles, realtors are concerned, once we close, you guys are squared up, and then the renovation begins with the draw. So for the lender side, we're not out of the deal. The contractors aren't out of the deal. We continue to work it until the last draw is done. Low first mortgage interest rate, it's relative, right? It's going to be lower than what a hard money loan would be. It's typically lower than what our construction to perm or builder business is while we're funding the draws. And then the one-time close. So when we close on it, we're closing on the purchase and the renovation at one time. And then again, saving the deal with problem appraisals. So let's jump into debunking some misconceptions here. And the ones that I share, I have heard all of them more than once. So first one here, the loan is for blighted properties or structurally damaged properties only. Not true. I mean, this could be, and I'm working on a few right now, where you could move into the house right now. The appraisals would pass now, but the clients have a vision of what they want this house to look like. And so instead of using their own money to fix it up afterwards, they'd rather finance that into the purchase and use the money for other things. Or I've seen it where the clients just aren't sure what additional cost there might be once they get into the house. And for everyone that's owned the home, you know, you buy it, you think you know it, and after you lived in the house for 6 months, you're like, oh man, I didn't know it did that. I don't like how that works. And so to have additional funds to be able to address it is helpful as well. So the loan is too expensive is our just debunking misconception 2 here. Again, it's relative again. It's not too expensive in relation to what hard money loans are. It might be more expensive to what a credit line is, depending on terms, but where I find the niche for the renovation loan is we're lending on after improved value, where the home equity line is going to lend on what the current value of the home is, right? Or again, another one where it might be, it's too expensive if someone's putting the renovation on a credit card that they have. Well, those rates are probably going to be obviously higher than what ours would be. So loan officers are not competent to do this loan. Sure. I mean, it's something I do a fair share of rescue deals, and some of the stories that I hear where they tell me what that experiences look like on their end doesn't make sense to me. And so there's definitely people out there that don't know what they're doing, or the companies they work for don't support that business in a way that can make them successful. Loan takes too long to close, or takes too long to close. I had one, gosh, it's probably been probably 6 years now, because I've been with guaranteed rate 5 years now. I talked to a lady and she had been in a renovation loan for a year, which my first thought was, who's still holding on to that deal? But she was, and she was just beside herself because she just didn't know how to get through the deal and how to close out the deal. So most renovation loans take 45 to 60 days to close. I have closed them inside of 30 days, but obviously you want to ask for more time that you need, so no one's overstressed out on not making a close date. And then that never closes. Yeah, that kind of goes on the heels of taking too long to close. But I think in any type of lending business, it comes down to two things. The loan officer has to know what they're doing, and the company has to have the resources to support them in what they're doing. So as long as you've got those two pieces, business will get closed, okay? And it's too complicated is number 6. And so this is where I feel like Guaranteed Rate has kind of figured that piece out, where again, to Penny's point in the introduction here, where she did renovation at another company and she had to figure it out on her own. At Guaranteed Rate, we write our business and we support other loan officers like Penny with their renovation. And so what that does is it puts the product in the right lane. We see renovation business all day long. And my team and my pod that underwrites and processes this, that's the business they see every day. So it's not one of those things where we do 2 or 3 deals a year, and every time we're having to kind of relearn how the process works. And it's on the back of the client's experience. And it also puts our relationship potentially in jeopardy for the agent partners and attorneys involved because of how that experience does or does not go. So it's something that we know this inside and out, and we share that with everyone involved, the clients and the agents, both, on how this is going to flow, what to expect, address any questions up front so everyone feels confident going into the deal. Again, everyone likes a good before and after picture. This one, I believe, is out of California. So let's talk about the flow. So just like any other deal that we would do, we start with the pre-approval, and then we got the home search, we get the offer in, it goes to be underwritten, we get the appraisal going, gets approved and closed, right? That's the same thing for renovation as well. What's different in is, again, where everyone else gets out of the deal, we're still in it. Once the closing takes place, the file moves from closing to our draw department. And then our draw specialist sends an introduction to me, the client, the contractor, saying you could start the work. Okay. And depending on the type of renovation that we do will dictate how many draws that we have and whatnot. So some of the things that also are unique is we need a contractor. Our appraisal is different. We got to get a bid. It's different. There's additional fees and the rate. So high level, I'm going to run through these really quick. The contractor, the client has to go find a contractor. We do not refer a contractor. The agent partners on this call, you may work with some. I tell people, get on your social media platform, say who knows a good GC that does X, Y, and Z. You're normally connected with family, friends, and people that like you, and they normally will respond quickly with recommendations. There's a contractor validation piece. We got to get a W-9 to make sure they got a business. Proof of insurance has to be done. Have to get 3 references of similar scope of work in the last 12 months. And then we got a contractor package that needs to be done. We have a list of approved contractors already that have done business with us in the last 12 months or less. The company doesn't give it to us, but if the contractor that's picked is on that approved list, we don't even have to jump through those hoops. But I've worked with contractors that haven't been approved before. They get their stuff together and we can get that done within a day or 2. It can move fast. Okay. I've had some where it takes forever because contractors are working out of the back of their trucks. They're on a job site and they don't have time to deal with paperwork. So those are all things we have to be aware of. Appraisal is unique in the fact that there's a longer lead time. Typically it can be 3 to 4 weeks, and we cannot order the appraisal or have the appraisal begin until we have the bid. And this, listen here, this is probably the longest delay in what we do. And so I tell people up front, in a perfect world, I am getting an executed contract as close to the same time as an executed bid as possible. And the reason why is I need that bid and contract to give to the appraiser so the appraiser can go out and appraise the property as if the work has already been done. So thinking the timeline out, if I'm telling you it's 45 to 60 days to close on a deal, and it takes 30 days to figure your contractor out and to get the bid over to me, and then I ordered the appraiser and the appraisal, and the appraiser takes 3 to 4 weeks, well, there's 60 days right there. And obviously we're doing things behind the scenes. We're still getting the initial approval. We're collecting documents. We're doing all those things, but it just puts additional stress on everything if we don't have that contractor and bid figured out as close to the front end of this deal as possible. Okay. As far as fees, there are additional fees that are associated with this. There's going to be contingency reserves on the bid. There's going to be draw fees to go out and inspect the work that the contractor does. There's title update fee to make sure there's no mechanic liens when the work's done. There's going to be permits. Supplemental origination fee is a fee that we charge because we have to have someone to manage the money and the paperwork while the renovation is taking place. And then the rate. So just for easy sake, I tell people up front, typically the rate is 50 to 70 basis points higher than what your non-renovation qualifying rate is. So if Penny qualifies a client non-renovation and it's at 5.5, we're probably going to be at 6, 6.25. Okay. And it's very easy for us to do that math, and they can have a pre-approval of each. So next 2 slides are going to be just a renovation loan program at a glance. Okay. And I share this screen because we have a plethora of different types of renovation loans.
Can you make this bigger, Jesse? I'm sorry to interrupt. I can't see it. Is there a way you can make that bigger?
I don't believe so. And yeah, it's maxed out on my screen. I'm going to run through some high points here. But
we'll be sending this out to everybody on the recording, and then maybe they can just make it bigger on their screen.
Yeah, I think I can attach the deck
to
awesome. It. So when
that'd
they don't see it, yeah, that's perfectly
Thank
fine.
you. Thank you.
So again, I've worked in other companies where we didn't have all these different type of renovation loans. Once you do this type of business, you learn of other people at other companies that do it well. I know there's other loan officers that specialize in renovation that don't have access to all this. So what you're looking at here, the first 2 is our FHA 203K, the limited and standard. I'm going to get into that. And then we've got the Fannie Mae Home Style and the Freddie Mac Choice. Those are conventional renovation loans. And then smack dab in the middle of those, we have the VA renovation loan. Okay. Again, most people that I know, most companies don't have access to all of these. Okay. So difference wise, the FHA, the 203K, all that is the 203K is kind of the most popular namesake for renovation loans. The process is the exact same, but it's underwritten on FHA guidelines. Okay. Home Style is underwritten on Fannie Mae guidelines, and the Choice is underwritten on Freddie Mac guidelines, and VA the same. Okay. So things to make note of on this slide here. Occupancy. Okay. FHA is an owner occupied product. So we're not getting into investments in second homes there. Okay. If you want second homes and investment, we're talking Fannie and Freddie Mac. Okay. Credit score overlays. FHA is obviously going to go lower. FHA is not rate sensitive, like conventional is for lower credit scores. And then it has a spot in here for self-help. Once I break it down to clients, we don't get into self-help. Okay. And if you want to have a side conversation in regards to it, I can explain it why. I'm not going to take up time here today. Maximum loan amounts. Typically, the maximum renovation is going to be what the loan limits are for the county or what the borrower's qualifications are. The one thing that we do have to make note of is on the conventional loan, the Home Style and the Choice, the renovation budget can only be 75% of what the after improved value is on the home. I'll say it again. Renovation budget on a conventional renovation loan can only be 75% of what the after improved value is on the home. Okay. Let me go to the other slide. I get asked frequently, what's the minimum that we can do? So the limited, which is the smaller version of the renovation. There's not a minimum, which people get shocked about that. And for the full or standard, it's 5,000. VA is 3,000. Okay. Maximum here's, so we can do up to 5 draws and up to 6 months in time. That's kind of the cap of what we will allow. So again, you guys can look at this when we send out the deck. I want to break down to you what the difference is between the 203K and the conventional renovation loan. I'm just going to pull all my slides up. Okay. So, again, think of the limited side of it. Those are the smaller renovation projects that we're going to do. Okay. So think of $30,000 or less in work and no structural work. If we have structural work, then it doesn't make a difference what the renovation amount is. We got to have a HUD consultant involved. Okay. On the home style and the choice, that limit goes up to 50,000. Okay. Now, using or giving an explanation of what the HUD consultant is. A HUD consultant is an extra layer of oversight to protect the client and to protect us as the lender. Okay. What their job is to make sure that the contractor doing the work uses national averages for labor and material costs. Okay. They're not there to kill the deal. Using a sports analogy, they're like a referee. They don't care who the teams are. They're just going to make sure we play by the rules. So going into more depth, and I don't need to go through all of these slides. I just want to point out a few things here. There's one more bullet point. Yeah. Okay. So with limited, the contractor gets half of their money right up front, and they get the other half once all the work is done. Okay. And that's how a lot of contracts that don't know renovation lending, that's how they expect to get paid. Okay. So I tell them when we're doing the full renovation, they're going to be paid on draws. And if there's any concern with that, on both programs, when we close on the money, 100% of the renovation budget is secured in an escrow account. So the assurance that gives the contractor is, as long as you do your job, you're going to get paid. Okay. In the limited, you cannot reallocate funds. So what that means is, if we don't use all the contingency reserve or costs come in less than what the budget was bidded out for, the extra funds go to pay the principal down on the loan. The borrower does not get cash back. Okay. Last bullet point, I already talked about it. 35 and 50 is the max on the limited minus any structural issues. So let's look at some things we can and can't do. Again, this will be in the deck. I'm not going to get into them all. I'll just share with you guys some of the things that I hear the most about. Limited, we can fix pools. We cannot install pools. The full K or the full renovation allows us to put in new pools. And think of it this way, as far as what things we can and can't do with the FHA and with conventional allows us to do luxury things. Luxury things would be the pool, the gazebo, tennis courts, a mural of your favorite renovation specialist, things like that. Okay. So to bounce over to the standard or the full, this again is the one that requires the HUD consultant. Higher level of supervision, that's alluding to our HUD consultant. And this does allow us to reallocate funds. So what we're talking about here is the borrower, if there's funds left over in the contingency reserve or from the original bid, they can do a change order to upgrade fixtures or do additional work. Again, whatever funds are not used out of that goes to pay the principal down on the loan. Kind of splitting hairs here, but I had a little bit of a blow up with a client in the very end that didn't understand this up front. When we close on the loan, regardless of all the funds are used or not, your loan is set. So if there's extra funds left over and we pay the principal down, it doesn't change your monthly payment. You're paying more in advance, so there's less interest on the back end of your loan. Okay. Again, getting into the weeds a little bit here, but just to explain. And again, another great before and after picture for you. Okay.
I think that's a really good point for everybody here. And if you have somebody and we talk about it, these kinds of things are excellent to know, Jesse, because they're the little minutia that buyers get excited about later if they're not told in advance. So setting expectation on these loans is, I have found everything. So
yeah,
thank you.
And it's something too, I mean, as you guys are probably hearing just with the slides right now, if you're not in it every day, it's a lot. And so we do a 30,000 foot overview with the client in the beginning, answer all the questions, but we understand they're not taking it all in. So as we get through different milestones, we're getting deeper into this program and process so they can understand it and feel more comfortable. It's one of those things it resonates more when you're going through it at that time. So we make sure to keep them informed as we go through. Same things here for the full. We can basically do everything with the 203K. We can't do those things that I already talked about and more, which is kind of crazy here. You can't do an outdoor patio with a fire pit. I don't know, 203K, I guess they think you're going to burn yourself. So for the 203K, again, I'm going to move through this slide. It's a renovation loan tied to FHA guidelines. Okay. I think the last bullet point is something here. It seems like it's come up as of late to me, and you guys might be able to relate to it. I get it where a new builder is building a home and they for some reason run out of money, right? And they're like, oh shoot, we need to find a solution to finish the build on our home. FHA has a problem with that. Their view is someone mismanaged the build, okay? And so they won't allow us to do a 203K if an occupancy cert hasn't been given for at least 12 months. We got to be a year post-build, post-moving into a home before we can use the 203K. We can do it on the conventional side, but we're still going to want to get clear on why the project wasn't able to get completed with the initial build, okay? Eligible properties, we really can do everything. The main thing that we can't do is any mixed use that would be deemed as more commercial than residential. It then falls into a commercial loan. Okay, but here's a quick view of the different things that we do. Single family 1 to 4, condominiums, gardens, mixed use, modular homes. Okay, let's jump over to home style, which again, I didn't update all these slides, but home style is synonymous with, you can call it choice. It's the same underwrite with the conventional. The guidelines are the same, are different. That's what makes the products different, but the process is the exact same. Okay. Oh, I moved my mouse too fast. So what's a home style? I already did a great job of explaining that, and it's just one close. Just putting all my bullet points up for you. Okay, so with a normal conventional loan, non-renovation, we can do as little as 3%, but that's going to be based on what the average median income is for the county that the property's in that you're buying. So not to get in the weeds, it's typically 5% or more, but yes, we can go as little as 3%. And we're going to lend again off what the after improved value is. There's the 75% of what the after improved is. Oops. And the luxury items, we talked about all that. So again, we can do pretty much every property. Where home style is different is we can do second homes, we can do investment properties. I get this a lot too. We can only do investment properties that are single family homes. We do not have a product for a 2 to 4 unit investor. Okay. And then here's our LTVs. Single unit, 97, 95. 2 units, 15% down, 3 to 4 is 25, 10 on second homes and 15 on single unit investments. What I'm finding right now, just based on where pricing is, most people are having to put an additional 5% down just because we're at the top of the rate sheets and we're having to basically buy down 3 to 4 points. So why pay points when you can just put an extra % or 2 down to make it work? Penny's shaking her head. She knows that pain. Eligibility, again, home style, we can do everything. Where what we can't do, projects cannot go longer than 6 months. Okay. And again, we're not getting into commercial. I'm not going to go through, I'm not going to go through this slide because we've talked a lot of comparisons and you guys can see the deck on your own. I will touch on this. So 3 to 4 unit FHA 203K, I love this product. Okay. So if we have an FHA loan, a 4-unit property, conventional, we're putting 25% down, where FHA, we can do as little as 3.5% down. We can fix up the property, rent out 3 of the units to where it basically cash flows and you can live in the house mortgage free. Now, FHA requires a self-sufficiency test. And for those of you that don't know what that is, it's only on 3 to 4 unit properties. And basically the rents that we collect have to cover what the mortgage obligations are. So that's insurance, mortgage insurance, taxes, but we take care of that on the back end. And then we have a Q&A here. So at this point, I don't see any questions that came up through the chat. I ran 100 miles an hour, so I would be glad to take any time to go deeper into anything that I said or any questions that you had, or even for those of you that have done renovation loans in the past and didn't understand why certain things went a certain way. I'll be glad to try to speak to that as well.
I have a question regarding the end rate with a increasing rate structure like we have today. Are we guaranteed just for 6 months until completion? If we don't get it done in the 6 months because of contractor issues, does that rate get changed?
When we close, the rate's a 30-year fix.
Okay.
So
we're
it's done. And I mean, technically, I mean, once we close on the loan, as a lender, we're on the hook. We say 6 months and we budget and we set expectations. But I've had deals that have gone more than 6 months. I had a deal or two that was in a historical area in the village or county, had to vote on stuff, and it took longer than what was expected. At the end of the day, if the renovation's not done at 6 months, they're not going to be like, well, we're just not going to complete the house. You know what I mean? We want to manage expectations in the timeline to get in and out of that deal in 6 months or less.
Well, a lot of the smaller deals, a lot of contractors are not willing to take them on. If there's if there's a lot of bigger projects out there, they try to turn their back on the small ones.
Right.
That's the only reason I asked that.
Yeah.
Right. Well, and this is for everybody. This is one loan. It's not like a new construction loan that something happens later. When we close, before the work is done, it's done. That's why nothing changes if there's a little money left over, because the loan is done. And it just goes towards that principal.
And Larry, with what you said, it made me think of this that I didn't share. So once we close on the loan, we need a minimum of 6 payments made on time evenly. You can't front load them all. But once that 6th payment has been made, if there's an opportunity for the client to restructure that debt with a lower rate, taking or reducing mortgage insurance on it, then they can redo that loan at that time.
Got it. New appraisal, of course.
Yeah.
It
would be viewed as a refi.
And one more question. I don't want to take up all your time, but the appraisals usually are appraised value or purchase price, whichever is less. In this case, it's going to be the appraised value after the plans have been approved and the renovation. So if that increases your equity by 100,000, that's your benefit.
Yeah, and again, not to get in the weeds here, I'll get people that say, oh, I want to put 10% down or 20% down. I tell them with renovation, put the minimum down. And then when we go to do the refi, if you were wanting to put 20% down up front, and if through the renovation, we build in 5% of equity, then maybe you're only having to put 15 into it and you're saving 5%.
All right. Sounds like a great program.
Yeah. I don't have
the program, the ones that I've done to completion and had it over the years, and recently had some great outcomes. Somebody brought a lake property. I forget, one of the outer lakes around here. And the property was, kind of broken down, and they bought it for just nothing. And when they were done, they had this gorgeous lake property, and the value that's going to grow in there. So I'm excited about the program. It's,
Yeah.
you know, it's great.
I don't know if I have any other questions, but what I would love to do, I know I allotted 45 minutes, which are right at the mark. I have a short slide on ADUs. And I
Please,
would love to get into it, but for anyone that
please.
needs to drop, feel free. Again, I'm going to record it. I'm going to attach this stuff so you can always get back to it if
That'd
you'd
be
like
great.
to.
Mm-hmm.
But I'm gonna jump into ADUs if I can. Okay. I think I got to unshare my screen and then reshare. So hold on. Okay, can you guys see my ADU now? Look at me.
Yes.
I'm a PowerPoint master. Okay, it's on a different screen, so I apologize if I'm looking over a different way. And I haven't done this deck as much, so I'll do my best to make it flow well. An ADU is typically an additional living area independent of the primary dwelling that may have been added to, created within, or detached from a primary one-unit dwelling. The ADU must provide for living, sleeping, cooking, bathing facilities and be of the same parcel as the primary one-unit dwelling. So what comes to mind to me, you guys might have seen this, it's like the coach house above the garage, it's like the garden apartment, something like that, okay? That's what we're talking about here. So what's some examples? We have the living above the garage, living in the basement. It can be a small addition to a primary dwelling. Manufactured homes, I visually, I can't think of how that would look, but they allow it. And then what we have to be mindful of what the property characteristics are of this. We got to have a separate utilities, separate postal address, and you got to have the ingress and egress to get out of it if it's like a garden. And it has to be legally rented if the property can legally be rented. So here's some things, and I've done a few of these, so I can share with you some of the things that have come up.
Can I ask quick, if you say you do a in-law apartment in the basement, you got to get a separate address for that? Do you know what I mean? You think?
By the
Apply?
guidelines, yes, technically, I have not had to get in the weeds on that.
Okay, all right,
But
okay,
you view it like this, is it's a completely separate space. You have to be
Sure.
able to have different doors to where you can't just flow through it, a different entry point as well. So
okay, thanks.
only one
about-
ADU. Go ahead.
What if I want to use this as an Airbnb? Can that be done or not?
We're not going to split hairs on it. You'll see it
Okay.
here that the borrower has to qualify without the rental from it. So typically when we get hung up on verbos and Airbnbs, it's the amount of time and the leases and stuff, and they're wanting to use that for qualifying. So since we're not getting into the qualifying piece, we really don't care what you're going to do with it. It's going to be more a definition of what is an ADU and what is not. Okay. Only one ADU is permitted on the parcel, the primary one unit dwelling. ADUs are not permitted with a 2 to 4 unit. I was confused by this, so I peeled back the layers on this to understand a little bit more. So with the renovation loan, where this comes into play is where, let's say you've got a 2-unit property now and you want to put an ADU on there. It wouldn't be considered a 2-unit with an ADU. It would be considered a 3-unit property. Okay, so it's more of how you classify it, but it's a great add-on product. I'm seeing a lot more interest and questions around this, and I think the reason this is becoming more popular is because as homes become more expensive, more people are wanting to offset costs, and so if they can build a revenue stream in there to help keep their mortgage costs down, it's a win-win. The ADU must be subordinate in the size of the dwelling. Again, it can't be bigger than the main primary home. And what it must have, again, the ingress, egress, kitchen, sleeping area, bathroom, and bathing. Okay. The ADU may, but is not required to include access to the primary dwelling. We already talked about that briefly. Must have. So if it doesn't have now, this would have to be added in the renovation to have it. Cabinets, countertops, sink with running water, and a stove or stove hookup. Okay. An independent second kitchen by itself does not consider as an ADU. True. And the removal of a stove does not change the ADU classification. Again, it's going to be all these things are required to make that classification. And here we are again, the borrower's got to qualify without the rental income coming from the ADU. So we're not going to require, or we're not going to check on the lending side if the permits are being required or not. That's going to be put on the borrower to work with their contractor to figure out. Same thing with zoning as well. And I did have this come up in regards to the appraisal. I think it's farther down on the slide. We'll get to it in a minute here. An ADU should always be considered legal if it is allowed under the current zoning code of the subject property, or if the ADU does not cause the subject property to exceed the total amount of living units permitted in the subject neighborhood. And this is when I've had the ADU questions, that's the first thing I try to understand is what are we zoned for here? What can we and cannot do? Because it can cause a lot of problems on the back end.
I was on a planning commission in our area for a while, and we had some things like that came up, and we made exceptions individually for property. So that will be certainly the buyer's responsibility to make sure that they're, taking care of their municipality's requirements with these.
Right. An ADU that is not legal can be accepted with 2 comps with illegal ADUs and evidence of the property is insured. So, and this goes along with when we're doing our appraisal, we're going to look for ADU comps as well. And that's another question I ask up front when someone says they want to do this. I'll say, is it common for the area? Because if we can't find any comps and there's no adjustments, the deal can fall apart at the appraisal. Okay. And then I don't know who Bree is, but it gives us an example of how an ADU would look. And for the agents on the call, you may have seen something like this. This is a basement. You can see the exterior door, the blue thing over there. It's got a separate bedroom, separate bath, separate kitchenette. And then here you can see it's got its own separate egress to get into it. So what we just saw with all those pictures is completely separate from everything else in this house. This would be considered an ADU, and with the renovation funds, hopefully we can budget a new paint job. So that's the slide that I had for ADU.
I like that. Sorry, I like that.
You like that house?
I do. I like those
There you
colors.
Yeah, so that's what I wanted to share with it. And again, when we take the time to do these presentations, my hope and goal is one, that you guys learn something new that you didn't know about renovation lending and ADUs here, but also to be able to help spread the word. I know, speaking for Penny and myself, we're always open to doing presentations like this over Zoom, or having us come into an office and talking to other people that might be interested in learning more about it. My long-term goal is that more people would be knowledgeable about it and be more open to it versus hearing, oh, I have a renovation pre-approval versus a non-renovation. I don't want to get into it. They're too hard, all the debunking things that we talked about, and they don't even want to entertain the opportunity for a client to be able to get a house to the way that they want to when there's a product out there that does just that. Any other questions? And you might have to unmute because I don't see anything in the chat if there is.
That was awesome. Thank you.
Good. Again, I appreciate everyone taking the time. I will stop the recording now. I will get this posted.
Wait 1 minute. Kelly, did you have a question?
Oh, I'm good. Thank you.
Oh, okay. Yeah, you guys contact me if you need anything after this, and we'll send you the recording and the dex sheet, the slides, right, Jonah?
Yep.
Very informative. Thanks for the hour.
Awesome. You bet. Have a great day.
Thank
guys.
you.
Yeah,
Thank you so much, Jonah,
guys.
Jesse.
Thanks.
Yep.
Bye.
Thanks, guys. Bye-bye.
I know.